Most traders fail because they don't trade systems. They trade guesses. They jump from indicator to indicator. They chase strategies. They blame brokers. They blame the market. But the truth is simple. They have no rules. Today, we are breaking down one of our most successful trading systems, the EMA 240 momentum strategy using MACD confirmation. This is a professionally based, rule-based system. You either follow it or you fail with it. Now let us insert it here. This is simple moving average. Exponential moving average. It is here. The period is here. 250, 240, and then this is exponential over the close, apply to the close, and then you choose your color here. That is okay. And then we insert the default MACD setting. Is a momentum indicator, so we have it here. This is it. First EMA, this is the setting. It is default. If you don't know the setting, just click reset. You have it. You have it here. Yes. Now this is the strategy overview. This system uses only two tools, EMA 240, as you have it here, and the default MACD. The EMA defines direction. So the EMA 240 here is going to tell us the direction of the market. That is what it does. And the MACD confirms momentum. The MACD tells us the momentum of the market. So we do not predict the market. We follow strength. We want to go with the market. We don't want to predict. We are not prophets. Now, what is the logic in this technique or system that we are showing you today? Markets move in trends. Trends are created by institutions. Retail traders lose by trading against these institutions. So for you to profit, you want to go with them because the volume of money they command, you do not command it. You do not have it. So what we do is that we wait patiently for our EMA 240, that is exponential moving average 240, to give us, to define for us the direction of the market. And then we wait, once the direction is defined, for the momentum of the market to pick up. Once that is done, we are good to go. So markets move in trends. Trends are created by institutions. Retail traders lose by trading against these institutions. The EMA 240 represents institutional flow. Price above it means bullish control. So when you have price to be above the EMA 240, that means we are on a bullish move, on a bullish setup. But that does not mean you should enter the market. We want to wait for confirmation. And when the price is below the EMA 240, that is bearish control. And that does not mean you should sell, because we need confirmation before we go with the flow. We trade with power, not against it. It is very, very dangerous for you to trade against the power of the market, the direction of the market. Don't do that. If you want to enjoy your trading, then you go with the flow. And going with the flow just to make trading very, very sweet. It makes your trading beautiful. It makes it easy for you to make money. It helps you to enjoy trading. So we trade with power. That is power trade. We want to go into the market when the trend of the market is strong and powerful, when the direction is very clear to us. You need to be patient and very, very patient in order to benefit from this. A lot of traders are not patient. They jump into the market when the setup is still information. Setups can be aborted. Do not forget that setups can be aborted. That is why we wait for confirmation using the default MACD. Now, we want to consider the trend rules. What are the bullish rules for this technique that we are bringing your way? This technique that is going to make trading sweet for you henceforth. For bullish markets, the price must be above EMA 240, as we have at this point. The price must be above EMA 240. 2. Not just must the price be above it, we must have at least 4 clear candlesticks formation that do not have any contact with the EMA 240. We don't want contact with it. So if the EMA is sloping upwards, it is an advantage for you. But the EMA does not have to be sloping upwards. Even if it is slight sloping upwards, then that is good. Higher highs and higher lows, that is good. When we begin to have higher highs and higher lows, here you see that the low of this is higher than this, like that, and then but then this broke it. At this point we begin to have higher highs and higher lows, but you don't have to be bothered much about that. But it is a good thing when you see that forming. So number 2, for bearish markets, we need price to be below EMA 240. Once the price is below EMA 240, as we have in this case here, then we begin to get ready for a downtrend to sell. We said that we want to have 4 candlesticks that clearly form below the EMA 240, as we have here. But in this case, the market retraces and touches EMA, or touched EMA 240. In that case, this down move is nullified, and we begin to wait for another move to have 4 candlesticks that are completely below the EMA 240. If you have lower highs and lower lows, that is an advantage for you. It is a good It is a good indicator, but it is not as strong. So you can include it as something to look out for, but you don't actually have to look out for that, because what we are most interested in is having 4 candlesticks formed below the EMA 240. If the EMA is sloping downwards, it's a bonus, but also it doesn't have to. So the most important rule there is for the price is for 4 candlesticks to form below EMA 240. If price is crossing the EMA, as we have at this point, market is touching it and all of that, price is crossing, no trade. The market is assumed to be in a transition period, so we don't consider any trade. Now, we want to consider the momentum confirmation, which is the MACD, moving average convergence divergence. This tool can stand on its own, but in order to filter the noise in the market, we introduce EMA 240 to determine the direction for us, to choose for us the direction to go. But your trigger is going to be the MACD, the moving average convergence divergence indicator. So we use default MACD, and for buy conditions, the default MACD must be above the zero line. The zero line. This is the zero line. Some call it the watermark. The zero line. This is it here. So it is very straightforward. So once the market crosses the zero line, as we have here, the market crosses it. That is the MACD histogram, and then we have the MACD signal line also crossing it at this point. Then we are in uptrend. So the histogram is expanding. It's expanding upwards. That is above the 0.00 level also, and it is increasing. So that means the momentum is increasing. So momentum expanding. When the momentum, you see, first of all, when the histogram crosses, the histogram is increasing. When the signal line also crosses the 0.00 level, it means the momentum is expanding. So once we have this kind of setup, we are ready to go. We are ready to buy. So for the sell conditions, MACD must be below the zero line. MACD here, the MACD is below the zero line. The histogram is expanding downwards. So when the histogram is expanding downward, that means it is increasing to down direction. That is here, the histogram is increasing to the down direction. Then of course the MACD signal line. Please note that both the histogram and the MACD signal line must be below the 0.00 level or the zero line. So once we don't have momentum, there is no trade. So if the market is touching the EMA 240, no trade. If we don't have momentum, that is both MACD histogram and the MACD signal line in the same direction, we don't have momentum. Now we want to consider the entry rules. So you need to listen very carefully, play this video over and over again for you to master the entry. That is what is going to fetch us the money we are looking for. Now the buy setup. The buy setup. Number one, the trend is bullish. That means the bullish trend is above EMA 240. As we have here, this is above 240. From here, it begins from this candlestick that refused to touch the EMA 240. So that is number one. Then there is a pullback. Our pullback is not determined by the formation of candlesticks. It is determined by the MACD. The pullback is, you see the MACD histogram coming below or forming below the MACD signal line. So at this point, the MACD histogram reduces until we have one that is below the MACD signal line. So that is the pullback. There has to be pullback. Of course, on the price chart, you are going to see a form of pullback, and this pullback must not touch the EMA 240. If it does, that means we are going to start counting again. So no rejection candlestick. We must not have rejection. Once the candlestick touches the EMA 240, the formation is rejected. Then MACD must be bullish. Of course, MACD must be above the zero line. And when we say MACD is above the 0.00 level, it means that the MACD histogram as well as the MACD signal line, which is the red line, are both above the 0.00 level. Then we now enter on a candlestick that closes above the MACD signal line. So in this case, we have this candlestick, this one, the one in front of the horizontal line I just put on the chart, closes above. I hope I'm correct, like that. So once it closes above it like this, that is this candlestick. The corresponding candlestick is our buy entry. So we buy here, and then we follow the momentum indicator. So we are going to be exiting the market using the momentum indicator, of course. So let me go over the buy setup again. Bullish trend must be above EMA 240. We pull back into the EMA without the market touching the EMA, and then we use the MACD histogram and the MACD signal line to determine whether there is a pullback or not. And in our case, we said that the MACD signal and histogram must go below the MACD signal line. So MACD must be bullish. Yes, MACD must be bullish, and then the MACD histogram must now move above the MACD signal line for us to buy, and we buy on the high of the candlestick that closes the candlestick that corresponds to the histogram that closes above the signal line of the MACD. 3 to 5 pips above that high is a good entry. So the reverse is the case for sell setup. In the sell setup, the sell setup here, as we have a place like this, so the bearish trend must be below the EMA, as we have here, EMA 240. Then there must be pullback into the EMA. We have the once we have this once we have this, it advances, then there must be a pullback into the EMA without touching the EMA, and then also the MACD histogram did pull back, and then the one that is now coming out, the first one, it must be the first candle, the first histogram bar, which is this candle, this particular candlestick corresponding to it becomes our entry. The low minus 3 to 5 pips becomes our entry, and then you just enjoy the market, because at this point the momentum of the market has become very strong. So pullback, bearish trend below EMA 240 number one, pull back into EMA 240, then rejection candlestick, that is the market. The market is not touching the EMA, and now the EMA is continuing in the former direction. MACD is bearish, and then there is break of pullback low. There is break of pullback low, and that is where the MACD histogram and the MACD histograms now goes below the MACD signal line, and then the candlestick that corresponds to that histogram bar that closes below the signal line becomes our entry. Now, where do we put our stop loss or take profits? You can, in our earlier video, we said that our pullback, our initial protective stop, that is, initial protective stop is the first stop you place when you just place your trade. It should be above the MACD, that is, sorry, it should be above the EMA 240. You are safe by putting it there, or you can choose to put it just above the pullback. In case you are selling, it should just be above the pullback, 3 to 5 pips above the pullback. Of course, that is not the best. Our best is that you should go above the EMA 240, and it should be in such a way that you are not going to lose more than 1% of your account balance. Please don't forget this. Your stop loss should be preferably above EMA 240 in case you are selling, and it should not be more than 1% of your account balance, because if we place 100 trades, we don't want to lose more than 1% if all the 100 trades are going to suffer setback. We shouldn't lose more than 1%. That is our standard. So if we are buying, our stop loss should be below the EMA 240 and not more than 1% of our balance should we have a setback. And if we are selling, our stop loss should be above EMA 240. If you are afraid of that, then you are buying, your stop loss should be below the pullback pullback low. That is the pullback to the 240. As let me show you, as it is here, if I buy here, for instance, now, then my stop loss should be below this pullback that didn't touch the EMA 240. It should be here, but preferably we want it to be down here. This is our first option, and then this is our second option. And then when you want to talk about profit taking, you can go That is now up to you, but you can go for minimum of ratio 1 to 2, risk reward ratio 1 to 2, or you can take partial profit at a ratio 1 to 1. So that means normally when we have entry, an opportunity to enter the market, when our confirmation is intact, we place 3 trades. So these 3 trades, one of the trades can go for ratio 1 to 1, 2, that is profit taking, ratio 1 to 1. Then the second one can go for ratio 1 to 2. The third trade must follow the trend. You must follow the trend and wait for only the only pullback to take you, pullback of the market to take you out of the market. And we said that our pullback is this. For instance, at this point, this is the first pullback that we are going to consider, because this is the first histogram bar that closes below the EMA, below the signal line of the MACD. So you can wait for the first one or the second one or the third one. We say they call the first one as good, the second one as better, the third one as best. So when we are making use of the third one to exit the market, it should be the lowest. If you are buying, it should be the lowest of the first 3 candlesticks that indicate pullback. So now let us move a little fast. We are going to consider risk management now. How do we manage our risk? See, we are not going to be risking more than 1% of our account balance. If you are placing 3 trades, all the 3 trades must be risking 1% of your account balance. And you don't place any other trade, even if you have another signal, any other signal. You don't place the trade until you are in profit and have reduced your risk from 1% to something less. And when you are taking another trade, your risk must be such that all your risk put together is not more than 1% of your account, or at most 2%. Our preference is 1%, but we have allowance of 2% of all your entire trade. What you see over the internet is that all your trades, you shouldn't risk more than 1% of 1% per trade. Our own is not per trade. All the trades that are running must not risk more than 1%. Yes, as a trader, you may not be comfortable with that, but if you want to live long in the market, if you want to be successful in the market, if you want to trade without emotions in the market, you must go by this our ideology, our technique of managing risk in the market. All your trades must not risk more than 1% of your account. You will always live to trade another day in case of any setback. What are the market filters we are going to use for this our trading method or trading system? You are free to trade anytime. You are free to trade anytime. It is a very, very reliable system. You see, in some techniques, you'll be told that you should trade only London session, New York session, or trade only trending market, tight spread, avoid news, avoid consolidation, avoid Asian session, avoid late Fridays, and all of that. Our technique, this technique, do not have inhibitions. whether they want to release news. In fact, don't bother yourself about news. Why? Because what you are risking has taken care of any eventualities. If you are risking 1% of your account and they release news, the worst you can lose is 1%. And I tell you, losing 1% means that with this powerful technique or system, trading system that you have, you can easily recover your losses and then make profits. Watch greed, overcome greedy trading. So you have almost no inhibitions. With this system, trade news. In fact, every day when you wake up, don't look at the news that they want to release. If you are not a news trader, don't bother yourself about the news, because whatever the news is saying is going to reflect on the market, and our system is going to have a good grasp of it. I tell you, take time back test the system, and you will be glad you come in touch with this system. Trade any session. Trade the London session, trade New York session, trade trending markets, trade news, trade consolidation. Late Fridays, yes, I may say that because of what happens over the weekend. I will say that you can rest from taking trades late Fridays. That is the only inhibition that we're going to be telling you. Not because it doesn't work or it won't work, but just go and rest and then begin your day when the market opens on Sunday. So, our trade example, let us show you some trade examples here. Of course, we have shown you some examples here before. Now, let us have some more examples. We want to begin from easy to tough markets. Okay, let's assume a place like this, and then we're going to move forward and see the performance of the system. So here the market crosses from down to up. This is the first candlestick that stay clear the EMA 240. You see that the low is not touching EMA 240, and then here we are having higher highs and higher lows. That doesn't really matter, but it is something you can also take cognizance of. So it is going, we have 1, 2, 3, 4 candlesticks. These are the 4 candlesticks that form above the EMA 240. 4 candlesticks. Yes, inside the box we have the 4 candlesticks. So this is telling us that the market is uptrend, but that does not mean that we should buy. We are going to go down to the MACD and check whether the MACD histogram and the MACD signal line are also above the 0.00 level. So they are also above the 0.00 level at this point. Yes, they are. That is a good one for us. They are also above, and momentum is increasing. So we wait for a pullback, and then we said that the pullback must be determined by the EMA, by the MACD histogram going below the MACD signal line, in case we are considering uptrend. So once we have this setup, once we have this kind of setup, we are getting ready to buy. So for us to now buy, we wait for the first candlestick that goes above the signal line, and in this case, so these are all retracement bars or retracement and histogram telling us that the market is pulling back, and this pullback did not get to the EMA 240. So the pullback was determined by the histogram, by the histogram forming below the signal line, which is the red line of the MACD. So this is the first one that crosses above. So here we buy. We are going to be buying. This is the candlestick that corresponds. No, this is the candlestick. I hope I get it right. This is the candlestick that corresponds to the histogram that closes above, that first closes above the signal line. But the market, it was not triggered, so at this point we would have set our entry, but it was not triggered. The market retraced and pulled back. This is telling us that the market has pulled back, so we wait again, and then this one closed above again. This is the first histogram that closed above the histogram bar. Please, for you to know exactly the first one, you are going to be making use of your data window. So once you place your mouse on the histogram bar or on the candlestick corresponding to the histogram bar, you are going to see that the MACD, the one that is called MACD, that is the histogram. The MACD, this histogram, is greater than the signal line. So let's see. Okay, that's 16, that's 15. Yes, it is this one that is greater. So we're going to be entering at this level. We buy, and then our initial stop loss, we said that is going to be the pullback. Our preference is going to be somewhere down here below the 240. So you can come and put your pullback here. When you enter here, you can put your pullback here. You see, you'll be risking over 100 pips, and a lot of traders cannot really take it because they say that you are risking much. You see some risking 20 pips, 50 pips. You can be sure that to a great extent the market is going to take you out, especially as a beginner. You need to be a veteran trader to know when to use very tight stop. But at the level of most losing traders, you need to allow the market to breathe. You don't have to bother, don't have to worry like that. Don't have to worry. You're going to enjoy the market. So your initial stop loss, just let it be below this, or you can let it be below 3 to 5 pips below the pullback. That is this is the pullback, the most recent pullback. This is the most recent pullback here. That is this level. So if you enter here, the market is giving a signal to enter here. So the most recent pullback is going to be this, which you will be risking about maybe 20 something pips, like that. Yes, about 20 something pips. A lot of traders will be comfortable with this. So when you put it there, the market keeps going, and then here you have the market did another pullback here, 1 1 2 3, which in our own terms we said this is okay. I think this is it. Good, better, best. So here you have to come out with a loss, a small one. Traders don't like to hear a loss. If you don't like to hear loss, or if you cannot bear it, you can just quit the market, because we are going to have quite a number of them. But what we do is that we minimize losses and then we maximize our profit. That is why we allow our profits to run. So that is that, and then the market retraces, and this retracement was confirmed by the MACD histogram going below the signal line, And then here we have a push-up, So we go with that. We are going to be buying with that push-up. We buy with the push-up. So the same thing, repeat the same thing for sell. When I want to sell the market, let me look for a good example for you where we have signal. The market comes down here, pull back, we sell, and then that is it. You enjoy your trading. So take time, watch the videos again. Whatever you have learned buying, just repeat the same thing when you are selling. The technique has the ability to help you escape shopping markets. Now, what are the common mistakes traders make, especially beginners and intermediate traders? Most traders that are losing make these mistakes. Trading against EMA 240. In fact, this EMA 240 is not even known by many traders. What is common over there on the internet is EMA 200. Though you may think that they are closely related, but there is difference between 200 and 240. 40 is that difference. Do not trade against EMA 240. It is a serious mistake, a big mistake traders make. So that is common mistake one. Another common mistake that traders make is ignoring MACD signals. Don't ignore MACD. It can be very, very costly. So when MACD is showing signal, take action. Do not ignore MACD. And then another mistake that traders make is trading when you are tired. Do not trade when you are tired. Once you are tired, it is an indication that you should go and take rest. Because trading requires all of you. It requires your concentration, your attentiveness, your commitment, your consistency, your timeliness, everything about you. Your spirit, your soul, your body is required. Once you are tired, please stay out of the market. Then overlotting. Overlotting is very, very serious. It is still a very big strategy that is unknown to a lot of traders. A very good strategy. Because many traders want to make money overnight. As long as you have not mastered lot sizing, then you still have a lot to learn. You still have a lot to learn. You still have a lot to learn. So you need to master lot sizing so that you don't crash when there is no need to even have a setback. Now, another mistake that traders make is entering without structure. The structure has not been formed, the pattern you are waiting for has not been formed, and you are just in a haste to enter. It is a big mistake made by a lot of traders. Now, This is the trading plan summary. This is one system for you. Stick to this system and make money for yourself. Stick to this system and enjoy your trading. Stick to this system and become profitable. In no time, you will see great improvement in your trading. Don't stick to a particular session. Trade any session. Trade anytime. Whether there is news or there is no news, you are free to trade. Stick strictly to the rules that we are giving you. If you are a beginner trader, you are just setting out on trading, do not trade many pairs. Trade 1 or 2 pairs. Journal everything you are doing. When you suffer losses, note why you suffer losses. Whether you break the rules or not. Whether you enter earlier. Whether you should have waited a little. This system works, but only for disciplined traders. This is Oracle's trading that brings you knowledge of secret trading systems. If you have not subscribed to our channel, subscribe now and turn on the notification so that anytime we upload our videos, you can receive them, you can be notified. Let us know about your questions, your troubles, your challenges trading, and we will be there for you. Share the videos and let struggling traders get liberated